Okay, welcome to the Capital Discussions Market Analysis. I'm Tom Nonemaker with Jim Riggio, and Tony Sizemore has joined us. But before we get started, we have a little disclaimer. This is at the bottom of all our web pages. Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, I can stop this sharing, and I'll give the ball to you. And Tony, are you with us?
Yes, hello, I'm here.
Hey, welcome.
Muted. Hi, Happy New Year, Jim and Tom and everyone else.
Thank you. How are you doing, Tony?
Doing good, just waiting on springtime. I'm going to be waiting a while, though.
Yeah, I think so.
Not for us down here in Florida. It was in the mid-80s today.
Go ahead. Yeah, well, you probably had to pull out your sweater.
I'm a weather wimp, but I haven't turned that bad yet. Okay. I'm still a good 20 years away from wearing a sweater when it's 85. Come on. Okay. The market is moving enough for you or what?
When we lived in San Antonio in the summer, a realtor always had a sweater with her because she always went from air-conditioned car to air-conditioned store or air-conditioned home. So she always had that sweater with her, even in the heat of the summer.
Wow. Yeah, the market's, moving around. I'm sure you're going to address that. I expected we were going to see some higher volatility. Just didn't know that it would come quite this soon. But it gives some good opportunities in a variety of ways, which I'm sure you'll talk about. So, hopefully we'll see a sustained area of higher implied volatility. Choppy up and down, which gives traders with short IV opportunities and traders with long IV opportunities. So timing might be a little bit more important here, I think.
Yeah, and not only do I think that that's more important, Tony, but the other thing that I think is really important these days in markets like this is to have your more durable trades. This is not the time to take out the sports car. This is the time to take out the all-terrain vehicle. Okay, because the market's moved around, pretty significantly. One of the things that Tom and I have done is that I had a Kevlar fly, very similar to what John traded in an M3. The one thing that I've done is actually I've taken the more defensive approach towards it, which is much closer to an M3. With the market moving around the way it is, it's very, very important to keep your T plus zero line as flat as possible. I'm sharing my screen. Tom, have you gone through the disclaimer already? Right. So that's good. And I have the ball. Can you see my the Buzz, the Goldman Sachs report? Okay. One of the things, Tony, I wanted to end up sharing with everybody was that over the last few weeks, over the Christmas, New Year's holiday, we ended up doing a lot of work in terms of we were looking at the report and we were breaking it apart. If I was to tell you that the volatility on the VIX options and the percentage of a 5-day move, not a one-day move, so it's not like just a one thing, but the 5-day move on the VIX, we hit 2 of the 10 largest 5-day moves since the VIX was introduced in 1990. Would you believe me? It's a trick question. Say yes.
I was waiting for that. Yes, I will, Jim.
There you go. What a good answer. Boy, our guests are so good. We got this report from Goldman, and they brought it out pretty much right away. But, here were a couple of things that I just wanted to end up showing you. On the top, Okay, what you're looking at is you're looking at the 1-week moves in the VIX. Okay, and you can see that in the middle of December, in the middle of all months, Tony, since you and I have been trading options, I mean, you had to go back to literally the, I think it was the early, it wasn't even the 2000s. It was in the 1990s when you had to find a December that was up, okay, in terms of the VIX. Here, not only was December up, but for that 1 week when in the middle of the month when we were dropping, it was it was the 5th largest weekly move on record. On record. I mean,
As
look at this.
a percent change of 78 then?
That's exactly what it is. I mean, look at this. On the list, there's one here from 1994. Okay, the VIX was introduced in 1990, right? Or you can see right here, it was in January of 1990. Right? So you had this unbelievable move. Now, one of the things that I took notice of from this was that I don't know if you remember the debt crisis.
I've tried to forget all about it.
Right? It was pretty horrible, right? And one of the things that kind of really shocked me, now, if you remember, it was 2011, right? Was it 10 or 11? I know it was August.
Which one?
It was the date. The debt crisis and the debt ceiling.
Well, yeah, I think that was, there's been several of them,
No, I'm talking about when the Congress didn't end up passing the budget and they were talking about default. It was right here. It was in 2010.
Yeah.
It was the spike right here. Right? You see the spike right in here? That's when the Congress didn't end up passing the budget. Now, I don't know if you remember this. Okay, I tend to remember my scars, my trading losses, a lot better than I remember my wins. What ended up happening was that we ended up passing the debt ceiling budget at the 11th hour and the 59th minute. We got downgraded over the weekend, but then volatility continued to end up going higher. And the reason why it was going higher was not because of what was going on in the U.S., but what was going on in Europe. This was when, there was questions whether the ECB was going to be, or the European Union was going to be able to bail out Greece, and what a Greek default meant to the markets, and volatility started to end up really picking up. And so while we were causing some of the issue, we were just like a piece of it, where the European debt issue was actually even a bigger thing, because everybody knew that this was just political wrangling, okay, between our Democrats and our Republicans, and in the end they'd end up getting it done. Okay, it was more a game of political brinksmanship, but the Greek problem was a real problem. We have that same thing happening right now. Okay, where there's a lot of discussion that Greece is not going to be able to end up, meeting their right. All of their numbers show that they're not going to be able to end up meeting their debt commitments. And so, what's the ECB going to end up doing? Okay, and the European Union, are they going to end up, letting them pay back on a slower scale? Are they going to end up? What are they going to end up doing? And the expression that I've become fond of using for Greek debt is that the probabilities are that the EU is going to let Greece kick the urn down the road, not the can, the urn down the road, because they're dead. I mean, they're going to have to default, but it's going to cause so much issues in political markets, in capital markets, that from a political point of view, they don't want to take that much heat. The other big problem,
Jim, I was reading a piece today that Greek elections, they're coming up on the 22nd, and the writer is saying the ECB is probably not going to want to do anything major until after that election. That's one of their policies. but I guess some of the politicians there are talking about just erasing all their debt, even the debt to the EU, to the ECB. So that's causing a lot of turmoil.
They are, and one of the things that's not very popular right now is the concept of austerity. They just don't want to end up hearing anything about austerity again. And so from a political point of view, if they're not going to end up doing austerity, their only other choice is to default.
Yeah, they're actually talking about pulling out of the EU.
And the other option would be for now, the problem is that pulling out of the EU is going to cause a lot of mess. Okay, from a banking perspective. And that's what you're seeing here is you're seeing the fear, okay, go into the marketplace. Now, do you also remember what happened in 2008 with oil?
All-time high, wasn't it?
It was. I mean, I don't think we can end up, can I go back to a monthly thing here? Let me see if I can end up coming here.
I remember there were two traders that decided they both wanted to trade at the all-time high, so they could just have their certificate of whatever that they bought or sold. and lo and behold, I think it was.
Now,
well,
take
historical at that point.
Right. Right. Take a look at what ended up happening with oil, right? Because I mean, it just, and I'm not sure, everything that's been going on with oil, but look at what happened to oil as we were going into our debt issues. Look at what just recently has happened here. One of the really big issues was that we ended up having a major support. If I showed you guys this a while ago, but let me show you. Okay, anyway, so oil broke $50 today. I mean, you can see that. If I come down to the daily, there was right in here, this was, and I should put up candles. If I ended up showing you a candle chart, this was a major doji support. This was the second highest volume day in 2 years. It looked like it held. We went sideways. We've kind of broken it, and we're starting to fall out of bed. So where we thought we had support, things were moving forward. That was going to be helpful. The problem right now is that not only do you have Greece failing, but basically the entire Russian economy at this point, okay, will get absolutely devastated with oil at these prices. So now what happens is that you have, okay, Russia in just huge issues, and if portions of Russia, whether it be banking industries or others, if they end up collapsing, what's the ramifications? I mean, what are the other dominoes that fall because of this? Okay, so, when I take a look at everything that's going on, there is just going to be huge volatility, I think, in the marketplace, either good or bad. I don't have a clue which one. That's why, if the problem is that it's very difficult to flip the switch and say, oh, well, I'm going to be a positive gamma, right? We're always negative gamma, positive theta traders. I'm going to be a positive gamma trader right now. And it's extremely difficult because it is so expensive to end up buying your volatility. That's why what I ended up doing was I ended up flipping some things over towards trading more John Locke M3. Okay, what I basically did is I'm using my old Kevlar flies with a couple of extra calls, but also moving my butterfly further below the money. Okay, so it's much more M3-like than the way I would normally end up trading it. And I think that you need to end up doing that to be able to keep your T+0 line flat. Because right now the market is, I think, in serious turmoil and can end up ripping one way or the other, depending on what kind of outcome we get out of Greece, the Greek elections, oil prices, Europe. And so even though we, okay, the U.S. was starting to end up having its economy get a little bit stronger. Real estate numbers were coming back, employment numbers were coming back. Things seem to be pretty reasonable. Now it's really it's the rest of the world that's going to end up being a huge drag on us. And, if you're uncertain what to do, it's not a bad time to sit on the sideline, in my opinion. If you are a positive theta trader and you're just trying to collect your theta, the other thing you could end up doing is just trade extremely small. I mean, very, very small right now. And when volatility does get higher, then you can end up putting on your trades, and you'll probably be able to receive a lot more for them. If a couple other points I just wanted to end up making real quick, and then Tony, I'd like to end up getting your opinion on it. The other thing that has been very interesting to see how we have moved was to watch the second derivative of the VIX, right? Watch the volatility of the options on the VIX, right? You know the VIX is a 30-day average of what the implied volatility is on the options on the S&P 500, the big contract, the SPX. Maybe, I don't know, it was maybe about 5 months ago or so, they changed it so they not only use the monthly numbers, but now they use the weekly numbers. And I think that what happens is you see a pretty fair move of it. That's the VIX. You know that there's a short-term VIX, okay? And let me show you that one. For you, those of you that don't know, there's a 9-day, right? Here's the VIX. Okay, there's a 9-day VIX called VIX short-term, or VXST. It tends to be higher but moves in great correlation, okay, with the VIX. And then there's also a 3-month VIX, which is VXV, okay? And it's not a bad thing to keep the 3 of these things on your screen if you want to take a look, and you can see where the fear, okay, is coming in. At what levels. The other way to end up doing it is to look at the VIX futures, and we've gone through that, and I've shown graphs on that, and I've shown you VIXCentral.com. I just wanted to end up showing you this. And since I started talking about the volatility on the VIX, what the VIX is, or the VVIX, it is the exact same calculation that they use for the options on the S&P 500, except for they use the options on the VIX futures. I know they're cash settled, so it's not technically the VIX futures, but they're priced like that probably 98% of the way. So you take a look at where this is, and a lot of times larger institutions will end up, trading these things, because when these things move, they don't move just a little bit. They move in enormous amounts. So because of the way that the skew works on this stuff, you can end up buying extremely wide call spreads above the money, and they're pretty cheap. They're pretty cheap. So for anybody who thinks is looking to end up looking at saying, how do I end up protecting this, never ever just go and buy pure calls, okay, on the VIX above the money. There's the implied volatility of these things is so high that, yes, when you win, you're going to make a killing, but you're going to lose so many of these things. Why not use the skew in your favor and buy call spreads on it? And you can see what ends up happening with this thing is that it can really, really pop pretty quickly, as it did in December. And as we started to end up moving again, if I go back to the graph, you'll see it here, right? VVIX. As you can see that we've gotten our recent pop again. Where does this one stop? If Greece turns ugly, if parts of Europe start to end up failing because of dead Greece or oil, prices, this thing can go way past the 142 high that we hit back in October. And if I show you the Goldman Sachs report again, And where was that? Here? Nope. Nope, not that one. Right here. 132, right? We have to pass 132 to end up getting on the list again. And where are we, okay, at today? 121 is a high.
Hey, Jim, I noticed the VIX futures were briefly in backwardation today. Right now, the January through June are all between 19 and 20, so they're all pretty close. So if you go to VIX Central, it's going to be a pretty flat line. Anything you can read from that?
Yeah, right. And you guys know that here. Let me pull this up over here. Let me get a new one. You know, again, the cash is higher than the futures. Right, the cash is the dotted green line. If those of you guys haven't seen this, a pure, very comfortable contango curve is when we're relatively flat, and then this thing just gets steeper and steeper. You know what it almost looks like, for those of you that remember, okay, like high school physics and stuff. It's almost like the path of a bullet in a vacuum, right? It goes down and just starts to end up dropping. So there's usually the biggest difference as a percentage between months 1 and 2. So you'd see a bigger percentage, okay, in this area than you would in between months 2 and 3, or between months 3 and 4. And now you're getting this very jerky type of curve where we're actually, you know, curving upward, not downward over here. So it's a scary market. Tony, how do you end up seeing what's been going on?
Well, you mentioned high school physics. I'll say this. The closest thing we had to high school physics at my high school was woodshop. So, so coming from that, you know, sort of background, I just want to throw that out there. Well, you know, you summed up a lot of similarities of the recent past, you know, from the beginning of the recession. I think you're drawing a lot of parallels, which are applicable right now for certain. What I try to do is look at, you know, all the information and just say to myself, okay, so how am I going to use this to actually, you know, to trade? I think you summed it up well by talking about having an all-terrain vehicle versus, you know, pulling out your, you know, your sports car or your, you know, your station wagon. I think that in between is where you probably want to be here. And to me, I would just ask you, you know, in these time frames, don't you think it's like really important to really set up your position so you can control the Greeks of them? So in other words, you don't really want to be leaning really long Vega or really short Vega, but somewhere in between, you know, so that you can ride out these daily fluctuations of the market up and down. And they don't have to be daily. You could get a, you know, what, 3, 4 day, 5 day, 6 day, 10 day move in one direction, followed by a rocket shot the other direction. You know, I think that I think you're right. I mean, there's going to be a lot of uncertainty. This is the year of the, you know, supposed tightening. You know, I think that a lot of times as non-directional traders, we do trade directionally, you know, if truth be told, we do, because sometimes we're long Vega or we're short Vega, and that is in effect a somewhat directional trade on at least volatility. But, you know, I think that by virtue of having higher sustained implied volatility premiums, the thing that's important, not only to me, but I guess a lot of traders that I've talked with over the years, is that we don't want to look at the high volatility as some type of a gift that all of a sudden we're able to sell options at much higher prices. What we should do is move those short options out further So we have to take into account what the statistical volatility is. We have to cover our positions, like you said. We have to make our lines as flat as possible, but still be able to earn, the type of return that we're looking for. But I think that the benefit to positive theta traders in a sustained higher vol environment, and I'm not talking about like the 1 or 2 or 3 day, big spike, but like the choppy, higher volatility environment, is that we can establish positions that are much wider in terms of their profit profile. And during the times when the market settles down and everybody takes a breather for a couple of days, our theta really comes in, relatively quickly. I think that would, for me, that would be the way I would operate right now. But I definitely don't want to be, really short Vega. I mean, at best, I want to be neutral, like have my Vega 1-to-1 with my theta. So if my theta is $500 a day, I want my Vega to be like, plus or minus 500, that type of thing. But I think you're right. I think, we've talked about it before. You've talked about it. We've all, been anticipating higher implied vol. But some of the statistics that you mentioned were, well, I don't know if the word surprising, actually, would be the word. Didn't realize that. And that leads me to another question. I don't know if this is off topic or not, but, the VXX trade, how does this play into that? The long VXX thing that you've discussed a lot of times.
The challenge with the VXX trade right now is that I've always tried to end up trading it so that I would end up putting on butterflies below the money. Okay, make them wide enough and have them be relatively short enough so that they can end up moving back in. The challenge that I've had is that I've had just too many losers on these things in a row because the market has moved up and we did not get any kind of normal seasonal pullback like we had in every other season since I began trading, 15 years ago. So we didn't get this pullback. And so what I've done right now is that I've stopped putting those on, and I've put on a butterfly or a section of butterfly that I almost adjusted back today. I end up doing the absolute worst thing that I could end up doing it here. If, let me make sure that I can end up showing.
We all do occasionally.
Yeah, I just have it on a different machine, so I have to just save it in a Dropbox and get it over. So.
Hey Jim, while you're pulling that up, we haven't really gone over any economic events, and the only 2 things I see for this week that are really, well, maybe 3: FOMC meeting minutes on Wednesday, jobless claims Thursday, and employment situation on Friday. So those could be some market movers, in addition to everything else that's going on.
Yeah, I think they can be, but right now I think that the overriding issue in the market really is a combination of grease and oil.
Mm-hmm.
Can I throw something, another idea out there, just to see what your thoughts are on it? We had a really good bull market if you look at the percentages over the last 2 years, 12 and 13. 13 and 14. How much of this sell-off would you attribute to the fact that most big players, hedge funds, you name it, whatever they are, mutual funds, how much would you attribute the sell-off to the fact that they didn't want to sell their core holdings that have done so well in 14 and then incur the tax liability for 2015, versus selling them on the first couple of days of the first week of January and push out that, tax liability all the way to next April?
I think that's very, very fair. I think that many investment managers don't consider the taxes as much as perhaps you would if you were trading. So I think that
Well, it's not their taxes. It's just a matter
not
of
their
the
taxes,
taxes
exactly.
of the yeah, right, of the holder, the
So,
investor.
so let's take a look at who's probably the
Well,
largest
I guess
personal
hedge
investor
funds.
now.
I guess well, hedge funds. They have a tax liability because of the way they're set up differently. They
On their
have
own stuff. So yeah, so you take somebody like SAC, right? Stephen Cohen Capital Management, right? SAC, and
Yeah.
this is all his money. He might care, but his tax bill is so big, I don't know if it matters. Okay.
Okay, so basically,
I
really,
do
the bottom
think-
line of that is that maybe for the individual investor who is a buy and hold or a long side investor, maybe said to themselves, man, I did pretty well in 14. If I sell, right now, I'm going to have to pay tax on the gain next year. If I wait 3 days, I can push it out a year and a half in case I have losses next year. So the individual
one could
investor,
have done
right?
that, right? Well, individual investors. Now, I hope that nobody on this call ever did this, right? Because if you were trying to postpone your tax liability, what you should have done last year is sold a covered call in the money, receive a little bit of premium, sell it far enough down, postpone your taxes for a year, and everything that Tony's talking is for the novice traders, and it shouldn't be anybody on our call or anybody in our community, because I would hope everybody would end up knowing how to end up using calls, selling calls, to end up basically taking their risk off the table while still end up postponing their taxes to the following year. And it's not considered a wash sale or anything else because it's an option you're selling.
Right. So I understand that, but say that again. Basically, what you would do is, if you have a long portfolio of stocks, you could sell the in-the-money, like S&P 500 calls, and that would neutralize your position delta, whatever your total position is, so that you don't have to, you don't have to take the risk of the market going down while you're trying to hold off paying your taxes, pretty much.
Right. Let's take, I guess when you consider the companies that I've worked for and the companies that IBM have bought, because they bought PricewaterhouseCoopers.
John.
I've worked
John
with people that have been in that company now for 20 years. For those of you who don't know, on January 1 or December 31st, however you want to look at it, when we finish this year, IBM has won a distinction of now being the worst performing Dow component for the last 2 years in a row. It's quite an accomplishment. The last company to achieve this honored position
I was just thinking that.
Bethlehem Steel. I don't know if you guys even remember Bethlehem Steel.
Well,
but, I mean, absolutely horrible. So let's say if you wanted to, and they could have been other companies. It could have been, you might have had gains in there if you bought it eons ago. But even if you take a look at somebody like Apple, okay, there's no reason why. Okay, if we take a chart of Apple, take a look at where it was, and say, if you wanted to end up selling something, you saw this come up, it came back down, you got a little bit scared, and let's say you wanted to end up selling going into the end of last year, mid-December, and it was at 112. Okay. Well, there was no reason why you couldn't have sold a 105 or a 100 call in late December. You're in the money, you received some of the money. Okay, you could sell it in January. Your tax liability would be when the stock gets called away from you in January. Oh, by the way, if it goes below 105, maybe you'd want to buy it again. Okay, so then you'd end up getting to keep your money, and it would end up working out extremely well. So you sell deep enough in the money calls so that it's below where you would end up feeling a fair amount of support. And what I would have done over here, if I would have been selling any place, in here on a bounce or, once you got through this stuff in mid-November, if you take a look, you had supported around like the 103 area here without question. If you ended up selling again, we just broke this support. So you could have been selling your calls, $5, $10, $15 in the money on Apple, you wouldn't get a lot of premium. Like, for example, if I was to take a look at what's a $10 or $15 in the money option going for right now on Apple. We're at 106, so let's take a look at what the 195s are. About a month out. I'm sorry, the 95. You know, you take a look at it, you'd get maybe, you know, $1.50 to $2 in premium, right? Selling it, you know, $10, $11 in the money. So you could end up taking, okay, that first $10 to $15 of risk off the table, and you could have gotten, you would have been paid an extra $1.50, okay, in terms of time premium if you would have sold it, and you would have paid taxes this year. That's why, you know, that's the way I would expect our members to end up getting out of a stock and postponing their tax bill.
Yeah, assuming
course,
that they
there's
wanted
some
to,
people
assuming they
probably
wanted to sell any, right? But you know, assuming somebody wanted to take their money off the table. But I mean, do you attribute any of, you know, the declines from, well, what is today anyway? The 5th. Was it Friday? Was the first day? Yeah, from Friday to today. Can I mean, you could probably attribute some of it to, you know, restructuring people, you know.
Well,
Right.
here's the one problem with that, Tony. And then the answer is yes, of course. Some of it, it is attributed to it. But also don't forget, at the beginning of every month, quarter, and year, okay, new money from pension plans, from 401k plans, comes into the market, and it's got to be deployed. That money is normally deployed anywhere. If you take a look at cash flows in and out, you know, the first few days of every month, okay, first 3-4 trading days, maybe the last trading day because some people jump the gun a little bit early. But in that week, if you take a look and say what week is the best historically within a month, you'd find from maybe, you know, the last 2 trading days and the first 4 trading days of the month tend to end up being like the best period in terms of the most money flowing in, driving pricing up. So did some money come out from tax without question? Yes. But I didn't see the money flows. So I don't know if more money had flowed out or flowed in. And it's kind of hard to end up depicting specifically where that money's coming from, because a lot of money could be flowing out now, because obviously money is flowing out now, but it could end up being because of fear of Greece, oil, the high yield stuff. Okay, high yield's gotten its butt kicked. Okay, and if you take a look at it, let me show you. Because what ended up happening is that a lot of those high yielding things were oil related. You know, there were a lot of oil trusts and things. And you can see that there was a fear here. The market's coming back down. Okay, they were like, okay, oil, what? By the way, this was, okay, the point where we saw that big reverse doji in oil. And so it's like, okay, if the oil trusts aren't going to default, we don't have to end up worrying, because a lot of people had those as collaterals, whether it be banks or other institutions. They had always been relatively safe. You know, who knew that oil was going to end up coming down more than 50% in a short period of time? So there's a lot of fear right now. So when it comes to the strategies, one of the things here, and I'll show you. This is the last thing that I'll show you, and then I'll turn the ball over to whoever wants to end up talking. If I take a look at what I had done, and I'd been better off if I just didn't kept my fat hands off of it. Okay, I put this trade on, okay, when volatility was higher. It was very much like a Kevlar butterfly that I had traded, okay, and I had done a class in New York. It's very much like an M3 type of trade that John Locke trades. I ended up having some a put butterfly. When I put this trade on, I put it on about 3 weeks ago, and we were approximately around 12.17, 12.18. I put this thing on very close to the break even at expiration. Okay, what ended up happening is we ran up. This was a short trade. I had a pretty deep sea of death, and I was like, okay, I guess I was wrong. The market's running straight up. So what did I end up doing? I ended up rolling up my calls, and then what I did was I also took off one put. So, that's where I am right now. I will be a little bit more tolerant on this thing, but if we get down to 1170 or so, I have to blow the whole trade further down. I'll take it off. I'll reposition at least large chunks.
A couple minutes. Right.
So that's what I meant by keeping. You can see that for a long time. And Tony, here's one of the biggest things with the negative Vega traders, which a lot of us are. If I end up showing you my slices here, okay, I'm short 2400 Vega. And I didn't mind being short 2400 Vega when I was over here. I mind being short this much Vega and being positive delta. Okay, I know that this trade can end up handling plus, especially later in the trade, and I'm in the tent, I could handle being plus 1,000 delta. If I get outside of the trade and it's starting to get steeper and I continue to be negative delta, I definitely have an issue. So tomorrow is probably, if we continue to sell off, it's going to end up being an adjustment day. One of the things that I have learned, and by the way, this one I attribute to John, on the trades when your T+0 line is flat enough, do not watch your position all day. If it's flat enough, okay, make your adjustments the day before. Otherwise, can you withstand another, let's say, 20, 30-point move? And the answer is I can handle another 20, 30-point move, okay, and I'll adjust at 3 o'clock tomorrow. I can't tell you how many times where you see this ugly early move in the morning only for it to end up bouncing back. I was about to pull the trigger today, and we only because the last hour did the market seem to find some footing, did I not adjust. If the market would have been flat or sold off in the last hour, I would have adjusted already.
Yeah, if I Thinkorswim's kind of hard to see on WebEx. The numbers across the bottom where the prices of RUD are, I can see 1170, 11. It's kind of hard to see.
1180
Where's your
here? Yeah, let me do this. I'll do 5 points up and five percentage points down. That's probably more realistic. So here's at the money. This is 5% up. This is 5% down.
Okay, so yeah, I see 1170. Okay.
And this
yeah,
is right. This is a January expiration, so it's not.
That's what I was going to ask you. Yeah, that's nowhere.
If this was a month out, I would have adjusted this thing a long time ago. One of the things that what I have found, and I think that John teaches this in his adjustment stuff. If you've ever taken his class, what I found is that you can adjust slower earlier in the trade. Later in the trade, you have to adjust more quickly.
More aggressive, of course.
Right? Yeah. As you get out of the tent, but you have to be more patient when you're in the tent.
Yeah.
So because I was in the tent right now, I have to be more patient than I normally would be if I had, let's say, 6 weeks left to go versus 8 trading or 9 trading days left to go. Since I only have 9 trading days left to go, you can take a look, and I know it's hard, so I'll end up reading you. My theta is 1773, and my delta is 431. Now, I don't look at ratios, and I don't consider it, look at that, I'm trading at almost 4 to 1, so no. The problem is that it's late in the trade. I'm close to the edge of the edge of my structure, and I'm also negative 2441 Vega. So I can't let this thing get much past. It's got to be definitely traded. Okay, once you start to cross your break even at expiration here.
Did you say you're late in the trade? I thought you said it's did I misunderstand? Is this a January expert? I mean, where in January? I mean,
Right
at the end,
here,
or
I don't know if you can see it, but it's the normal January expirations. So
that's 2
it's not
weeks.
this Friday, it's next Friday.
Yeah, that's the expiration I've got. Right, exactly. So, okay, I'm sorry. You know what? When you said January, believe it or not, I was still thinking December. I'm still on. I'm still on. I'm still on holiday mode. That's what threw me off. I'm sorry. You said it exactly right, though, Jim. You know, yeah.
Welcome back to work.
Yeah. Telling me. Yeah, you know, you've. Yeah, I mean, you're exactly right. I mean, what happens when you get closer to expiration is you run out of places to hide. You can't adjust to various things, and you know, taking a position that turns out bad and just moving it forward because you don't want to take a loss is not really a good idea. But yeah, I mean, I think you know, you've made a lot of good points. You know, from a you know, I'm sure a lot of other people have questions. Like Ray says, Jim, what would your adjustment have been? I see that on there. Um,
I
you know,
didn't. I deleted them all that I had up here, but let's talk about a couple of them. A while ago, okay, I would have thought of possibly just taking off the butterfly. By the way, if you take a look at what I did here, right? Let me just tell you through here. So this was my initial trade, right? Here's the butterfly. I bought 2 extra puts at the bottom. I bought 8 extra calls. Then when I did the adjustment, look at what I did for the adjustment. Basically, I rolled my half of my short puts up 20 points, and to keep my leverage, okay, and not have not have my risk go up at all, I also rolled these long puts up 20 points. So I just rolled the whole thing up, and the way you end up doing that is with by selling a condor. Okay, if you want to take a look at what the condor looks like by itself, this was the condor. Okay, so basically I rolled these puts up. Right, terrible trade, absolutely terrible trade. But it had looked like everything. You know, the bell was clear. We could end up moving up. And what I was worried about being late in the trade and being in here in the valley of death. So I said, I better start to move that up and start to manage that. And so I flattened it out. It looked really good. You know, and when we were over here, you know, a week ago, things were looking great. But we've sold off extremely hard. So, you know, the first thing is if it's early enough in the trade, I'd consider just undoing what I did. The problem is that if you take a look, and people can take a look at all of your gamma numbers and everything else, what I will tell you is that this T+0 line just bows too much. It's not flat enough. Okay, so in this market, this is a terrible adjustment in my opinion because it's just pot luck at this point. You're just shooting in the dark, hoping for it to land someplace. So what I think you have to end up doing in terms of adjustments on this is you need to end up kicking out some of your shorts. Now, there's 1 or 2 ways to end up doing the adjustments, and here is the. I can take a look at where my shorts are. Okay, and by the way, I look at the graph, right? I know that I have short puts at 1180 and at 1200. So, you know, one of the things that I could end up doing is that I don't mind making these adjustments because if I take a look at a 1200, and let's say if I roll down some of these things, right, I could take 1200, buy a vertical, maybe even roll some of them down below the current short strike, maybe down to 1160 and do, I don't want to do back ratio, I just want to do a vertical. And if I did maybe, I don't know if that's going to be too much. Yeah, that probably is.
Jim, how long would you keep this position as it is right now? Let's say that the market does recover or stay sideways inside of your profit zone. How long do you think you would keep your current position going forward from here? I mean, what kind of target zone, like from, well, obviously none of us look at maximum potential gain at the very top of your tent, but do you use like what kind of metric do you use to determine? Let's suppose things could just best case scenario, they just go sideways from here. You gain all your theta, this week. When would you close this trade in terms of what area of profit, and how do you determine that?
I was looking at this. When I end up doing it, I would look at the planned capital number. Okay, and never look at the amount that was in the trade. Okay, the planned capital number on this was $150,000. Okay, I thought that I'd start here. If I needed to end up buying a couple of extra puts at some point, that gave me an extra, $25,000. So I was reasonable with that. Just like when I had to roll things up, some people would roll. If you roll just your call, just your short puts up, you'd end up having a margin issue. So what I ended up doing was that I ended up rolling up and I took money off the table. I love to make adjustments and lower my maximum expiration loss. Okay.
Sure.
I like to do that, right? Because I know I'm taking money off the table with adjustments. I'm not adding risk to it. And if I'm in trouble, I should be not adding more money to it. So I take a look at that. So I was hoping to be able to end up making maybe 10% on this trade. It was about a 3.5-week trade. Trying to pull out 10% out of what your planned capital number is a reasonable number for the amount of risk that you're going to end up taking. I can't let this thing get to be minus $15,000, okay, because that's all I was planning on making. So when I take a look at because I've had to make adjustments now, I've lowered my expectations. I'm not going to make $15,000 on this. But hopefully I'll try to end up making 10. If I can widen it out at some point, I will. Maybe what I'll end up doing is that I take a look at what's going to cause me the most pain. What's going to cause me the most pain and what will end up, by the way, let's define pain. Okay.
Good point.
Okay, I just realized that. If people sometimes think about delta, your pain doesn't come from your delta, because what ends up happening is that when you move, your pain, if the market's moving down, your pain will be constant because you have zero gamma if you're just, say long a stock. Okay, so it's very symmetrical and easy. What happens to options traders is that your pain becomes asymmetrical. It actually can go parabolic on you, because your
it's just like a thumb screw. They just keep tightening it down and down and down.
Oh, and the thing is that the pain will just become, and it gets worse, okay, every time they screw it down on you. Okay.
That's what most options traders fear is that it's going to get worse.
Okay. So the position,
so anyway, just jumping in.
Right,
there.
the position that's going to cause me the most pain are these nice short puts that are here that are just full of premium. Okay, that are going to go from a 50 delta to a 90 delta very quickly if we start to drop and time goes by. One of the things that ends up happening, and you know what, this is a great opportunity to end up showing this. Tony, that was a great question, because here's what I want you to end up seeing. Let's take a look at 10 strikes. When I go, and again, I don't know if you can see my delta here, so I'm just going to end up saying the, let's just go a couple more. Let's go maybe 15. So let's take a look at the 1150 delta ends up being a 26. The 1200, or let's say the 1220 delta, is an 86. Okay, that was the 1120 and the 1220. If I come out here and I take a look, I know some people do this, 50, 60, maybe even 70 days. Here, if I look at that 1150, let's highlight them both. My delta is 26 here. It's 36 here. If I take a look at that 1220, my delta was 86 there. 1220, it's 61 here. So if I was to map out the deltas, you see what ends up happening is that the out-of-the-money deltas drop or go closer to their natural, either 0 or 1, much quicker. So that's why the delta is much, much higher of this strike of the 1220 with less time. Why? Because that's pretty much very deep in the money. So it's going to go to a delta of 1. And every single day, if nothing else happens, that delta is going to get higher. This delta is going to inch up a little bit. Why? Because, there's 73 days left to go before expiration. Here, we only have 10 days. Really, only 8 trading days left, right? Because today's gone and doesn't trade on Saturday when it expires. So when I take a look at my trading days, not a lot of trading days left. Okay, so this is the problem, right? This is the problem with it. My deltas are going to change. This is why when people talk about when you adjust positions, and if you look at your deltas and your gammas without understanding where you are with the amount of time of expiration, I think that you can really get blindsided. Trading close to expiration, people end up getting very excited about because, they take a look at this graph and this, oh my God, look at how much money you could end up making. And I know there's some people out there saying, Jim, what an idiot. You mean you'd be happy with $10,000? But that expiration graph says, even if you hit the middle of it, you're looking at $85,000. It's a mirage. It doesn't really exist, okay? If it does exist, the level of risk that you have to take to make that mirage actually happen is so high, you need to be prepared to end up losing everything you have in the trade. Now, if you traded this smaller and you are willing to accept the maximum loss and you think that it's going to end up finishing in that range and your risk tolerance is okay for you to lose 100% on the trade because you traded it so small, that's fine. That's fine. This trade is too big for me to end up, losing more than that. I don't want to lose more than about $15,000 on this. I don't want to lose anything. But, I have a risk tolerance of trying to make 15 or lose 15 on this specific trade.
Well, and you can do other things too, like if you have some profit, take like 80 or 90% of it off and leave a couple of lottery tickets down to try and hit the mirage. But you're controlling your loss.
I love to do that, Tom. The thing is that when it gets small enough, if I have a butterfly on, and once if I take it off and I can't end up losing money, and then if I get my profit target off, oh yeah, it kind of ends up satisfying everybody, saying, see, I was able to take it into expiration. But what ends up happening, I don't know about you, Tom, but if I leave one contract on, I know I'm going to nail the center of that butterfly. There's not a question about it. We're going to finish there. If I have on 1,000 contracts, we're going to finish so far away from that butterfly, I'm going to need binoculars to see the strike.
Human psychology.
Well, Jim and Tony, we're right at an hour, so I don't know, is this a good place to wrap it up?
Tony, any other things that you wanted to end up adding or questions that you might end up having?
Yeah, just I think you made a really good bunch of points tonight. I'll just ask one question. Really, don't have anything to add right now. I think we've talked about all that. But what in terms of indexes, do you see going forward over the next couple of months in terms of the big 3-4 indexes? All right, S&P, the RUT, the NASDAQ, and maybe I don't know, throw in whatever other index you might want to throw in. Do you see any, what index do you think would be the best one to trade in terms of, I know that's very subjective, but in terms of a positive theta trader, like most people are, here with us tonight, do you see any index settling into being lower beta compared to the rest of them, or what do you see in that regard, if anything?
Kind of interesting. Okay. First comment was today we had fear of foreign markets. Okay. So what happened was that there were portions of the day when the Russell was stronger than the other indexes because the small caps don't have as much exposure. And even though the Russell has a higher standard deviation or volatility of whatever you want to consider it, it ended up losing less money, right? It was only down 0.91% versus the S&P futures being down 1.38. So I think that going forward, that the implied volatility in this environment, because it's a foreign a catalyst, that the Russell may end up not having as much downside volatility as, say, the large cap, the S&P 500, because of it has a much higher exposure. In addition to that, you also have to take a look at what percentage the energy sector ends up playing in this with oil. So those would be the factors that are going on right now that you'd have to take a look at.
I agree with that as 100%. Yeah, actually, the Dow was down at 1.9%, SPX was down 1.8, RUT was down 1.5, and NDX was down 1.6. But you were talking about the futures.
Yeah, I was looking at the futures.
Here's the other thing. Look at the RVX was up 7.1% today. VXN, which is the NASDAQ Volatility Index, was up 7.8, so that's kind of comparable. But here's the VIX, up 12.9. You can round that up to 13. I mean, that's almost twice, the others. So I think, I think that was you're thinking exactly the same way I am. I don't know if that's dangerous or not, but but yeah, I think the RUT and possibly even the NDX, I'd stay away from SPX and DIA right now, in my opinion.
By the way, for those of you who want to take a look at this, remember these are the things that I look at all the time. Here's the VIX, okay, and then everything that Tony mentioned. Okay, the RVX is the VIX index on the Russell 2000. The VIXN, the VXN, is the VIX index on the NASDAQ, and the VXD is the VIX index on the Dow Jones. Right? So you should look at those, and I have them as a percentage on my other machine. This is my list where I can see what's going on market-wise and what's driving things. Okay, these are my indexes.
Well, very good, gentlemen. I think it's a good time to stop, and I appreciate everybody coming. Tony, especially, thanks for stopping in. Always welcome.
Well, thank you, guys. It's good to talk to you guys. It's always good to talk to Jim, and always, of course, good to talk to Tom, and good to see all the other successful traders that are on this call. It's always good to see it. So thank you very much for allowing me to be here. I learned a bit. Well, not more than a bit, actually. So I'll shut up, and you guys can take it from there.
Tony, thank you. Thank you for coming. You're always welcome. We always like having you on to be able to talk to you.
Thanks, man.
And then, Jim, you're presenting on Thursday with some covered calls, right?
Yeah, one of the things, and I'll just do a quick 30 seconds on this. There were several other Goldman Sachs reports that I wanted to end up starting to talk a little bit about. A 16-year study on writing covered calls that ended up having some really interesting facts in it that I'll end up going over. Also, they talk about how to end up actually, if you wanted to, you can end up using options to do anything. You could take your options and create a stock and actually have it yield, okay, have a return of a yield like a bond with actually lower risk. And they go through some of the studies. We're going to end up doing kind of an introduction on this, an overview, because what we're going to be doing is that we're going to be starting a covered call class in a couple of weeks. Tom, have we finalized dates on that?
Not yet. I think it's going to be in about a week and a half to 2 weeks, though, so it's very soon.
Okay. And we're going to end up going over so that, and I'm going to end up showing you how you can adjust your risk profile to what's most comfortable for you. Sometimes you'll have stocks that you don't want to end up getting out of, but they have too much risk for you right now. We'll show you how to end up lowering them. Some of your stocks you'll want to end up collecting more income. We'll show you how to end up writing covered calls and being able to end up doing that. We'll show you how to end up putting on and the right amount of protection for you. I'll show you different options, and we'll end up answering a lot of questions and taking a lot of examples from you guys.
Very good. Look forward to it, Jim. So again, thanks everyone for joining us. We won't take up any more of your time. Don't forget there's trading groups on Wednesday at noon and 8:30 p.m. Eastern. You're welcome to join those or watch recordings, and look forward to any meetings that you participate with us in. So thanks again for joining us.
Thanks, everyone.
All right. Bye-bye.